Well, on the margin, this seems to be sort of a transition in the phase of the credit cycle from what we call our kind of mature expansion to our early contraction. Seen a lot of pieces of evidence that really fit into that mold. Number one is that high yield spreads are widening. Number two is that there's a couple of one-off situations that the markets seem to be particularly afeared of, if you will. So that combination suggests we're moving towards a more conservative portion of the credit cycle. Spreads are likely to continue widening for some time, but credit availability for healthy corporations is still in good shape, so there's no obvious economic effects at this point.
Paul Tudor Jones said last week we're in a global debt bubble and we are headed for some very scary moments. What makes you think we're not?
I'm sorry, I cut out for a minute. Would you please repeat
sure.
that?
Paul Tudor Jones was interviewed last week, and he thinks that we are in a global debt bubble. He said last week that he thinks we're in for some very scary moments. How do you kind of...
Yeah, so credit availability has expanded massively, and nowhere is that more obvious than in the leveraged loan space, which is basically high-yield loans collateralized by assets. And that sector, even as compared to sort of the credit boom of the mid-2000s, early 2000s, that sector is 2.5 times its size. The quality of loans have gotten a lot easier. And I think what's also important is growth in that sector and lending has helped fuel broader economic activity. So as that sector in particular contracts, it could be painful both for investors as well as for the broader economy. I agree, of course, there's going to be painful moments in a down credit cycle, but there is not the sort of evidence that we have that the big credit expansion that really caused massive problems in the sort of 2007 to 2009 period.
You know, Guy, I think part of the problem, people look at it and think, okay, it was really smart to be borrowing a lot of money with rates so low. Good companies were doing it all the time. There are plenty of companies that borrowed a lot of debt, that have great balance sheets, that even have cash that they could pay off a lot of it if they chose to do so. How much of the debt that's out there right now is held by those companies versus how much is held by companies that are facing declining times, that are maybe struggling even in a strong economy, and what happens if the economy turns down?
Yeah, I mean, I don't have a magic number to be able to, or a dividing line to really separate those two out. I mean, the sort of traditional dividing line is that between high yield and investment grade credit ratings,
right.
triple B and above, and below triple B. And, you know, I think the area, again, to reiterate a point from a moment ago, that provides the most concern is this leveraged loan sector that both expanded so massively, and for the most part, the underlying assets don't have explicit credit ratings. They have implicit credit ratings driven by a model. Mm-hmm. And so that sector, it's really hard to measure how powerful it's been in providing fuel for broader economic activity. But that's the sector that really provides the most concern, because not only is it sort of this shadow-rated subsector of the financial markets, but in addition, it's been sold to many individual investors as a lower risk asset class. And I don't think that's actually the case, particularly at this point in the credit cycle.
You're particularly wary, though, of bank loan funds, right?
Yeah, exactly. So, and this is a comment about the sector as a whole. It's not a comment about any managers or any specific assets. But the issue here, and I've referenced it a couple times, is the massive expansion, the deterioration in credit quality, but more than that, the way in which it's been sold to individual investors via investment in mutual funds. So these are complicated assets. They're high-yield assets. Yes, they are generally collateralized by physical assets at the various underlying businesses. But if there's a broad credit downturn, valuations on this sector, this bank loan sector, is likely to deteriorate quite rapidly. Unlike in the 2007 sort of time frame, we don't have that bank bid backstop nowadays.
Guy, let's go back just to the demarcation line that you just laid out, the demarcation between the junk bonds and the investment grade bonds. There was an article over the weekend just laying out that there could be a real avalanche of bonds getting moved from one side of that divide to the other side, that there's a massive number at the lowest rating of investment grade, based on how a lot of different S&P and Moody's both measure these things, and that if those companies face another downgrade, you are then talking about a huge swath of what was previously investment grade moved down to junk bond status, not just GE, but a large number of others that could go that way too. Would there be a problem if that happened?
Yeah, absolutely. So we call that transition a fallen angel. It's usually what the ratings agencies refer to it as well. And essentially what it results in is, as a bond is downgraded from triple B minus to double B plus by 2 out of 3 ratings agencies, many mutual funds and insurance companies and other investors who previously held the bond for either legal reasons or capital reasons, they have to sell it. And so you tend to get a really big drop-off in price when that transition happens. And sort of economy-wide, we haven't had a kind of massive transition from BBB minus to BB plus. It's certainly a greater risk this time around, and a lot of it is driven by the sort of technical nature of legal agreements with mutual funds that just invest in investment-grade debt, or insurance companies that have to hold out a lot more capital if a bond gets downgraded below investment grade.